Now we're discussing the same principles that we did for the whole syllabus yesterday. So starting with the concept of securities itself. Now when we talk about securities, we're only looking at it from the perspective of India in this syllabus. And we're also looking only at securities that are usually traded on Indian stock exchanges. Securities in general can be categorized into equity-based securities, debt-based securities, and securities that have advanced features. Usually, equity-based securities, you would already know that are called as equity shares, right? But also, some of these other shares, which are called preference shares, can also be converted into equity shares. So, in general, we're going to put both these shares into the category of shares first. So, shares will be divided into equity as well as preference shares. Equity shares, on the other hand, can be further divided into ordinary shares, which are mentioned as OS, DVR shares, which is those shares that have differential voting rights, and SE shares that are called sweat equity shares. Ordinary shares usually carry one vote per share, meaning all the shareholders that hold these ordinary shares usually can vote in the general meeting depending on the number of shares that they own. So that is the special feature of these equity shares. On the other hand, we have DVR shares, which carry sometimes more than and sometimes less than one vote per share. Why this voting discrepancy usually arises is mainly because these equity shares are not usually issued to regular shareholders. These are equity shares that are issued to MD, CEOs, and chairman of the board, usually. This is also an equity share which is used as a preventive mechanism to prevent a hostile takeover. Whenever one company tries to acquire another company just by purchasing its shares, such a process is called as a takeover. So, if you issue one equity share, which is going to carry a lot of votes, so if one share carries 10 crore votes, even if another entity ends up buying all your other shares from the public, the person who owns this one share is going to still have the power to decide what happens in the company because his votes are going to overpower everybody else's votes, usually, right? And whenever decisions are taken in general meeting, that is taken with the help of a majority of the votes. So irrespective of how many shares that other people have or own, the person who owns this one share is going to decide whether a matter should be passed in a general meeting or not. Hence, such power is usually reserved for very important and trustworthy people of the company, usually people like managing directors, chairman of the board, CEOs, etc. Such a share carries more than one vote per share, so it is not equal to one. That is why we call them as DVR shares. Usually, when these shares are given to these important individuals in the organization, they generally don't carry any dividend rights because these are the two rights that every investor usually wants from an equity share. Either you give me voting rights or you give me dividend rights. If you give me more voting rights, automatically the dividend rights will fall. And if you give me less voting rights, automatically you have to pay me more dividend. Only then people will be interested in buying these shares. So usually companies, when they give less than one vote per share, they end up giving more dividend in general. So let's say if you have one equity share, which gives you only 0.1 vote per share. So you need to own 10 equity shares to vote once in a general meeting. So in such a scenario, people would rather prefer more dividend. So people who can't attend general meetings, people who are usually busy, people who do not stay in the same city as the registered office of the company, because that is usually where the general meetings are conducted. So such people would rather prefer a share which doesn't give them much voting rights, but it gives them an extra 10% dividend every year. So even though they end up paying the same amount of money, they will receive significantly less voting rights. So both these shares, the shares which give you more votes but less dividend, or the ones that give you less votes but more dividend, both of these shares are going to be categorized into DVR shares or differential voting right shares. On the other hand, you have the third category of equity shares, which I've mentioned here as SE. SE stands for sweat equity shares. Sweat equity shares are the only equity shares that are issued to directors, employees, and promoters of the company. 1 second. So the sweat equity shares, whenever they are issued to either directors or employees or promoters of the company that are either director or employees in the same entity. Sweat equity shares are always issued usually to people who spend the most amount of efforts in bringing the company up, whether by giving ideas or whether by working more towards its objectives. So it will either be directors, employees, or promoters who are either the directors or employees of the company. Such people obviously deserve a discount in the purchase price. So the only equity share that can actually be issued at a discount to face value is a sweat equity share. So in case you're doing problems involving journal entries, I'm sure you would have faced these scenarios where they would have taught you discount on issue of shares. Those scenarios actually do not exist in real life unless it is a sweat equity share. So these are the three categories of equity shares: ordinary, DVR, as well as sweat equity. Any questions or doubts under equity shares? Anybody? All right.
So what's the difference, like a very broad difference of sweat equity shares and ESOPs?
ESOPs come under the category of derivatives. ESOPs don't have their own value. They derive value from the fact that the company gives you the option to purchase these shares in the future. So they are future-oriented derivatives. They are not technically considered to be a share at all. If you get an option, you will get an option to buy the shares in the company only after a few years. They will not issue the shares to you immediately. That is why we're going to put them under the categories of derivatives and under the category of option. It only gives you the option to buy. So let's look at a scenario just so that you are clear with what an ESOP is. So let's take the case of Infosys here. And let's see what the price was. This was the price yesterday. Price went up by another $50. So 1425 is the price of Infosys today. So if you join the company today as an employee who's at a senior or reasonably high position, so let's say you are joining in the legal department and you're given 1,000 ESOPs. ESOPs are also not issued at a discount. They are issued at the fair market value of the company's securities. The fair market value, if you're joining Infosys today, is 1425. But you won't get the option to buy all these shares today itself, because what's the point of buying a share which is worth 1425 at the same price, right? So rather than you going to the market and buying these shares yourself, why would the company give you these shares at 1425? The reason being, they want you to work harder for this company. They want you to stay longer in this organization. And ESOP is actually a HR management tool. It is used to retain employees in the long term. So let's say you're given 1,000 ESOPs today at 1425. You are required to work in the company for 3 years in order to be eligible to receive these ESOPs. Every company will put a condition somewhat similar to this. Some companies would say 2 years, some companies would say 1 year. It differs from company to company. Their main aim is to retain you in the organization. So what proposition they will give you is, I'm going to offer you these ESOPs at 1425, but after 1 year, you can take 30% of the offered ESOPs. After 2 years, you can take another 30% of the offered ESOPs. And after 3 years, if you continue to remain in the company, then you can take the balance, 40% of the available ESOPs, which means if you work in this company for 1 year, and if you work hard and hopefully the organization also achieves its objectives, the profits will go up. And what would happen to this 1425 after 1 year? Will this go up or come down if everything goes according to plan? What do you guys think? It will go up. So let's take a price of 1525 after 1 year, 1625 after 2 years, and 1725 after 3 years. This is what you're expecting to occur, because you're going to work hard. You're a solid employee of the company. You're putting in your 100% efforts. So this is what your expectation is after 1 year. But in reality, this may not always be the case. You got the ESOP at 1425, but in reality, after 1 year, the shares could be 1,700 also, or if things don't go according to plan, shares may come down to 1,000 rupees also. Both are possible, right? So in this scenario, you have the offer to buy these shares at 1425. If the share price goes up at 1,700 after 1 year, you have the ability to exercise 30% of those 1,000 shares. So you will receive 300 equity shares at a price of 1425 after 1 year. But you will only choose to take these equity shares at 1425 if the company is doing well and it's at 1,700. So if it is at 1,700, you will go to the company, you will pay 1425 to the company, and you will get 300 equity shares. And the rest of the 275 rupees that you are earning, if you sell these shares immediately, will be your profit. But that's not always the case. All companies are not going to perform well all the time. So what if the company performed poorly? You did very well. You worked great as an employee. So you think that automatically you should be able to receive the shares at 142. But what if every other employee did not perform well in the company, right? That is also possible. So after a year, if the share price is at 1,000, would you go ahead and buy the shares by paying 1425 or not? What would you do? Would you pay 1425 if the market price is 1,000, or will you not pay 1425?
Ideally, I wouldn't want to pay 1425, but since it's a predetermined rate, how is it going to work?
It's a predetermined rate, but it's not a predetermined contract. The name of the contract is
Option.
What does the word option mean? Option gives you the right,
Choice.
gives you a privilege, but you can always back out of that privilege, right? So what are you going to do now is you're going to say, if I'm getting the same company shares at 1,000, why would I pay 1425 to my own company and take these shares? So you're going to cancel and back out of this contract. This ability to either take up the contract or cancel the contract is why these are called as employee stock option plan. Is this clear? So similarly, over the period of 3 years, you will be given an opportunity to reassess. So let's say after 1 year, the share price is at 1,000. Fine, you didn't exercise it, but these shares will still be added to your account in the background. You can still exercise them after 2 years or 3 years or 4 years or whenever you want. Whenever you feel the price is right, you get the option to exercise these at 1/4. And if you decide to not take up these shares, sometimes you might have financial difficulties. Sometimes you're running short of money. 1425 is not a small amount for buying 1,000 shares. So that's 14,25,000 rupees. That's not a small chunk. So if you don't save much money to buy these shares, you can always reject these options. That is why they are called as derivatives. Let's come on.
One question. So generally options, like you said in the other class, they have come with a small price, right? So they take a small price. So that's the difference between futures and options. And
that option would not be applicable. That price is not taken for ESOPs. That's an exception. So not all options are ESOPs. ESOPs are one type of option. There are other types of options also, which we'll discuss today. There is something called as DSOP also, which is exclusively given to directors. So employees can't access DSOP. Directors can't access ESOP. You and me can't access both. We have to go to the market and then buy another option for Infosys in the future, because we don't work for Infosys at all. So we should also be given an opportunity to buy options. So employees are not charged any premium while entering into an ESOP contract or a DSOP contract, but we, that is the normal public, will be charged a premium of a certain percentage to get into this contract. Yeah. Moving on to preference shares, typically they are also categorized into three varieties: convertible, cumulative, and participating. Convertible preference shares are those that are converted into the equity shares of the same company. So you buy preference shares, you receive equity shares later on. Cumulative preference shares are those that will pay you dividend irrespective of whether the company is having a profit or loss, but they will accumulate the unpaid dividend. So they will pay the unpaid dividend by accumulating it and paying it in the future. So if the company for some reason suffers a loss, typical preference shareholder will never receive that year's dividend forever. But a cumulative preference shareholder, that year's dividend will be added to his account, and whenever the company makes sufficient profits, that time they will receive the unpaid dividend amount from the previous years whenever the company had suffered a loss. Participating preference shares, contrary to belief, you cannot participate in the general meetings of the company. Only shareholders can do that. But participating preference shareholders will participate in the surplus profits of the company. Every company has an average rate of return, which is usually declared on an industry basis. So if you take an industry which has, let's say, an 18% rate of return on average, this year for some reason they made 25% net profits. So that extra 7% profit that we have made, that will be distributed not only to equity shareholders, that will be distributed some portion to preference shareholders also. Such a preference share which gives you the right to access this surplus profits to some extent. Obviously, equity shareholders will still receive a majority of this profits, but one portion will be given to these preference shareholders who took the risk to purchase these participating preference shares. Hence, such a preference share will be called as a participating preference share. So those are your shares. Then we come to debentures, bonds, and notes, which we're going to call as debt instruments collectively. Debentures, your typical interest-bearing security, which may or may not be secured. So you may have a secured or unsecured debenture. A secured debenture will provide the debenture holder the right of charge. Charge means you have the right to sell any specific asset of the company. Charge is also of two types. You have fixed charge and floating charge. Fixed charge is a charge which the company determines. So company will decide what asset will be sold if the company is unable to pay the debenture holders back their money. Floating charge is the charge where the debenture holder will decide which asset to sell of the company. Usually, debenture holders will pick a very valuable asset. So if you were a debenture holder, what asset of any company will you pick in order to sell it and get your money back, which is considered a very valuable asset? Would you sell furnitures, fixtures? Would you sell the debtors, or would you sell the land and building? What would you sell if you were a debenture holder?
Land and building.
Land and building is an appreciating asset, usually reasonably retains most of its value. So if you give this power to a debenture holder, they will obviously end up selling land and building, which is a critical asset for the company. So does the company like issuing floating charge-based debentures? No. Companies prefer issuing fixed charge-based debentures. Charge will only be given to you as a right if you are buying a secured debenture. Some companies issue unsecured debentures also. As an investor, it is not very appealing to you. So you should ideally not invest in an unsecured debenture if you're looking for investment advice. But companies in India do take advantage of the lack of knowledge prevalent in the country in general. So they do sometimes end up issuing unsecured debentures also. Now, if for some reason a company has gone desperate and issued a debenture with floating charge, debenture holders are going to obviously sell the land or building of the company. Let's say they sell the land. This process of deciding which asset to sell has to be decided amongst all the debenture holders. So they will be required to be assembled in a meeting, which will be called as the debenture holders meeting. In this meeting, they will decide which of these assets will we be selling. The process of deciding which is that final asset that the debenture holders have selected in order to sell, that process is called as crystallization. So when a floating charge gets converted into a fixed charge, that is, the debenture holders have now decided we are going to sell the land. So now the charge is fixed on only one asset. So when the floating charge becomes a fixed charge, that process is called as crystallization, and it is going to occur during the debenture holders meeting. So there are two types of charge, fixed and floating, and the process of conversion of floating to fixed is crystallization. If a debenture doesn't mention your name at all, then such a debenture is called as a bearer debenture. And if it only mentions one person's name, then it is called as a registered debenture. And typically, debentures can also be converted into equity shares sometimes. So if a company allows you that option, such a debenture will be called as a convertible debenture. Based on bonds, you can divide them into three categories similar to debentures on the basis of convertibility. If you convert a bond and receive equity shares of the company, then it is a convertible bond, otherwise it is a non-convertible bond. If the bond is issued in Indian currency, it is an Indian currency bond, otherwise it is a foreign currency bond. If it has a fixed rate of interest, then it's a fixed interest bearing bond. If the interest keeps fluctuating based on the performance of the company or the performance of the market or the stock exchange or any other criteria that the company has decided, such an interest bearing bond will be a floating interest bearing bond. So on the basis of interest, on the basis of currency, and on the basis of convertibility, have three categories of bond. But under this, there is a special category of bonds, which are called as FCCB and FCEB. This is a currency which uses foreign currency as a bond, and it also gives you the right to convert the bond into equity shares of the same company. Meaning, if Infosys issues you the bond, and after a few years, you get equity shares of Infosys itself, then it is a convertible bond. And if it is issued in foreign currency, then it is a foreign currency convertible bond. The bond was issued by Infosys, and you get equity shares of Infosys itself. Hence, it is a foreign currency convertible bond. But if the bond was issued by Infosys, but instead of getting equity shares of Infosys, you get equity shares of Wipro, then such a bond is called as a foreign currency exchangeable bond. When would this happen? Whenever Wipro has borrowed any money from Infosys and Wipro is unable to repay that loan, obviously Infosys is not going to just sit there and not receive that money. So what Infosys will do, is get into a loan repayment arrangement with Wipro. And they're going to say that, fine, I'll give you 3 years more time. You can repay this loan after 3 years. But after 3 years, you have to give me some of your equity shares also. Let's say 10% of the loan amount. So Infosys, let's say, gave a loan to Wipro for $1 million. Wipro could not repay it. So after 3 years, Infosys extends the loan and says, after 3 years, you will repay me this loan, but you will repay me 1 million plus 10% of 1 million, which is 100,000 US dollars worth of equity shares of your company you should give. So whenever Wipro repays this loan after 3 years, Infosys is going to take these equity shares and it is going to pass it on to the foreign currency exchangeable bond holders. So if you get equity shares of the same company, it's a FCCB. If you get equity shares of some other company, it is FCG. Any questions here? Okay. Notes, on the other hand, can also be categorized on the basis of interest and convertibility. Usually, notes in India are issued only in Indian currency. So you can either have fixed or floating interest notes or convertible and non-convertible notes. One second, guys. They are called as debt instruments. Now, coming to other securities, before we go there, all of these securities that we have discussed, they have a specific market value. For example, Infosys has a market value of how much, when you look at the screen, how much is the current market value of Infosys? Can you guys observe and tell me what the market price is?
1425.
142.25.35. Now you would notice the face value of these shares is only 5 rupees. So contrary to popular belief that a share will be 100 bucks or 10 bucks, the way sums are usually taught to you, the biggest IT company in India itself debunks that idea with a face value of 5 rupee per share. This market capitalization that I'm showing to you on your screen is shown as 591,547.67. How do you find this out? So market price is nothing but the ability for you to determine, if you sold all the shares of the company today, how much money will you be able to generate? So market cap or M cap is equal to the market price of the company multiplied by the total number of equity shares that the company has issued and not yet repaid. This is the formula for market capitalization. So Infosys has issued about 415 crores shares till today, and the market price of these shares, as you all observed, is 1425 rupees. So if you put this in a calculator and calculate, you will receive 1425 into 415 crores. So you have to add the zeros. So that's 591375 approx. If you go back and look at the stock exchange, we have rounded off. So somewhere near this number itself, the market capitalization is 5,91,547. So that is what is called market capitalization. If you look at some other terms here, previous closure is 1365. So yesterday the share closed at 1,365. It opened at 1,379. The highest price it went to today was 1,429. And the lowest itself was the opening price. VWAP is the volume weighted average price. So this is the price at which most of the shares were bought and sold today. The average price at which. In the last 1 year, the highest price that Infosys has gone to is 1672 and the lowest has been 1215. If the price reached 1501 today, they would have suspended the trading because that is called as a circuit breaker or a circuit filter. So every day, based on the market price, they will take a 10% up or down. And they will calculate the upper and lower price band. Whenever the company's price hits this amount, they will suspend the trading in the securities for a few hours. In the last 2 weeks, 4.1 lakh shares on an average basis have been traded for Infosys. So this is how you read some of the terminology associated with these stock exchange portals. All right. So that is MCAP. That brings us to derivatives, and which is pretty much the right time for the old syllabus guys also to join in. So till here, if you guys have understood the principles, talk about BSE and NSE because they are recognized by SEBI because they have adopted a scheme of corporatization and demutualization, meaning that these are stock exchanges that are corporatized. They are both companies. Their name ends with the word limited. So BSE itself is a public limited company and NSE itself is also a public limited company. The full form of BSE is Bombay Stock Exchange, and they have an index which is called as Sensex, and NSE has an index which is called Nifty. Nifty has 50 securities and Sensex usually has 30 securities bundle. These are the top 30 and 50 securities which are divided usually on the basis of the market capitalization, for which the formula we just discussed. So if you have satisfied the requirements of SEBI, SEBI has many requirements. You should have sufficient net worth. You should have sufficient infrastructure. You should have sufficient amount of employees. You should have sufficient amount of net worth. If you have satisfied all these conditions and then you have set up nationwide trading terminals, that is, every tier 2 city in the country should have one branch office of yours, then such a stock exchange will be given the status of recognized stock exchange. So currently in India there are 2, BSE and NSE. That is the place where all these securities are traded. Any questions up till now? Hopefully everything is clear. Any doubts?
In the example that you gave, where did you get the 1425 from?
1425 is the market price. Do you see the left hand top below BSE logo?
Okay, sir. Thank you.
Okay. So suppose in the question they do not provide you this data, yes? Is there another doubt?
Yes, so how did you get the how many equity shares they have?
So we had done this problem yesterday itself. There are 2 ways to arrive at this. One, either you look at their balance sheet and arrive at that number, or you can reverse calculate also. So if the market cap is according to BSE itself, if you look at the market cap, it says 591,547 crores. Okay, so what is the formula for MCAP?
Market price into number of shares.
Market price into number of shares. So let's say I don't know number of shares and I don't have access to the balance sheet also. I do know what is the market price though. It is 1425.35 into number of shares is 591,547, right? So if we take a calculator, and let's say we calculate that, 591,547.67 divided by, you take 1425 to the other side, 1425.35, you'll get approximately 415 crores. So number of shares issued is 591,547 by 1425, which gives you approximately 415 crore shares. Be clear?
Yes.
All syllabus students, hopefully they have joined. Can I get a quick confirmation from you guys? All syllabus people have joined the meeting.
Yes, sir.
Yes, sir, join.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
So we're going to move on and understand issues and intermediaries today. And also I will give you weightage for these chapters eventually. Let's not worry about what's going to come in the exam and what's not going to come in the exam. I'm also assuming some of you might still be in college, so I will also provide you an alternate timetable towards the end of the class today, which you can use, which I pretty much used when I was in college, because I managed to somehow do this course while I was still in college. So second sem was when I wrote my CS foundation. There was no CS EET back then. All the papers were descriptive also. But in CS executive, we used to have 8 papers and all of them were again descriptive. I wrote that in 4th semester of college, and 6th semester of college I wrote CS professional, and as soon as my college got over, results usually come out at August 25th if you write the June exam. So kind of got to know that I had cleared all the papers. In spite of scoring less than 70% pretty much my entire life. So those who are wondering if anything is a difficult course or not, I tell this to my chartered accountancy students, I tell this to my LLB students also. Usually your job is to not look at whether a course is tough or not. You need to look at whether you like the course and what do you find benefits with respect to doing this course. For example, there are already 75,000 company secretaries in India, more than that actually right now. So you can say about 45,000 are in employment, 35,000 are in practice. So all you need to ask is, how many companies are there in India which require a CS? Do you guys have any idea how many companies require a CS? Do all companies require a CS or not? I'm sure all companies don't. Which companies require CS? I'm sure you would have thought about this before joining the course. I'm assuming. Otherwise, this road is going to be quite downhill. Does anybody have any guesses regarding this?
Yes, sir. Minimum paid up capital is 1 crore or 10 crores. I actually confused.
Okay, at least you're somewhere near Manoj. That's good. So, first of all, remember that we are discussing in SLCM about listed companies. SLCM or CMSL, however you want to call it. Listed companies are private companies or public companies? Are they privately held or publicly held? Or could they be both? Any guesses here?
Public companies, sir.
What are the companies in India? If you really look at, there are only 3 types of companies in India in general. So you have OPC, which is one-person company. You'll learn about this in module 1. Private companies, which can have members of up to 200, and public companies, which don't have any limit in having as many members as required. So public companies can be either listed or unlisted. And if you're a listed company, yes, CS appointment is compulsory for all listed companies, obviously. But are there 75,000 listed companies in India? Probably not, right? That is where this rule of paid up capital of 10 crores. So currently, if any company in India has 10 crores of paid up capital, such companies are required to appoint a full-time company secretary. So when I managed to do this, there were very few people who were company secretaries. And when you go and say CS to somebody on the road, they will probably say computer science back then. I'm not sure what the scenario is today, but I still remember that used to be the case back then. So let's say you go and ask any pani puri vendor or any fruit vendor, that's what they would probably say, some sort of computer related course. So nobody knew what this was. You're getting into the course at this point of time where more than about 1 lakh companies exist in India, which actually have a paid up capital of 10 crores of. I'm talking India, guys. I'm not talking Bangalore. So have an open mind regarding where you might be placed, when you might be placed, what could be your potential employment opportunity. All of that you need to visualize and get into a course. Don't just do a course because it's fancy or it's trend, or just because some of my friends did it because they didn't want to do CA for some reason, or you just feel that this might be a good option for you. You need to research the data behind what is happening in the country, how many jobs are there, are you going to fit into these limited opportunities, and then take up this particular course. Some of you are also doing LLB. Somebody pointed out this to me in the other class. So that's a good combination to have, LLB and CS. Definitely your employment opportunities will increase quite significantly if you do manage to do LLB, but none of you have to worry about getting a job once you do a CS in general, because there are enough opportunities even today. But the more important question is, do you like law? Can you prepare for it? Are you in or out of college? How much time you can give? All of these are things that you need to think of. And only then can you eventually aspire to be employed in a listed companies, because the number of opportunities here in listed companies is quite less compared to other public companies and other private companies which have a paid up capital of 10 crores or more. Our syllabus only focuses on listed companies. We don't care about public, private or OPCs. Okay, so whatever you're learning in this subject applies only to listed companies in India, which are listed either on BSc or NSE. And for getting listed, they have to sign an agreement called as a listing agreement. Always remember this. So SEBI is the regulator of the subject. They regulate stock exchanges also. Stock exchange will regulate intermediaries, and through intermediaries, companies will issue securities and investors will purchase and sell the securities. This is the structure of this syllabus when you're trying to study. So irrespective of whether you're in new or old syllabus, there are certain points that you guys need to remember, starting with issues. Whenever a company issues a security, it could be a public issue or it could be a private placement. It could also be a rights issue, or it could even be a bonus issue. These are some scenarios where securities are issued. Whenever securities are issued, you need to take the help of primary market intermediaries. Intermediaries which help in creating the security are called as primary market intermediaries. And the market in which a new security is created and sold for the very first time to the investors, that market is called as the primary market. So the stock exchange itself has two markets, primary and secondary. First, a security should be created, then only it can be traded. So if you want to buy Infosys today, you have to pay 1425, right? But the face value of Infosys is only 5 rupees. So when Infosys issued these shares, would they have issued them at 5 rupees or 1,425 rupees or some other price? What could that be? Face value of Infosys is 5 rupees.
Excuse me, sir. I'm not able to listen you. Please increase the volume.
I am at pretty much top volume. Anybody else facing this issue?
No, sir, it's fine.
That's fine. I guess you would have to check your internet connection and log in again, probably one more time. Okay.
Okay, sir.
So when we talk about public issues, this is the very first time a company issues a security. This public issue can be of two types, IPO and FPO. IPO is called initial public offer and FPO is called follow-on or further public offer. Wherever any company for the very first time approaches the public and asks them to invest in their company and offers them their equity shares for the very first time, that is called as an IPO. So you're approaching everybody. Anybody can invest in this company, right? So when Infosys initially did it, let's maybe Google this and find out what was Infosys's IPO price. Maybe you'll be able to get a clear number. So now, (1993) was when Infosys was initially set up and their securities were listed. So I think it was somewhere around $100. Yeah. So back then, though it opened at 145 rupees per share, the issue price, if you notice in this paragraph, and if you read this, trading opened with a huge premium of 145 per share compared to its issue price of 95 per share. In March 1999, it issued ADRs, which we will discuss again later, equivalent to 10,35,000 equity shares at $34. And they were listed on NASDAQ, which is your New York Stock Exchange, and their Sensex. So what they're basically telling you is, if you invested 95 rupees in Infosys, your current return is 1425. So that's quite a significant amount of return, right? More than 10 times your money has multiplied, and in between they had did some bonus issues, some rights issues also. So keeping all of that in mind, this 95 rupees is what is called as the issue value or issue price. So you have face value, you have issue price, and then you have market price. Face value of Infosys is 5. They did their IPO at 95, and the market price today is 1425. Can anybody tell me what is the securities premium then that they collected? How much did the company collect? Looking at this.
Securities premium is the additional money that the company collects on the face value of the share.
So how much was it here?
145.
No, that is the opening price. So that 145 that you saw in the article is the price at which it opened. Remember this open, high, low that we just discussed? So a 5 rupee share, company demanded 95. So they demanded a 90 rupee securities premium. But on the first day when it got listed itself, it reached 145 rupees. So on the first day itself, it started demanding a premium. That was how much demand was there for Infosys shares, even in 1998, 1999. So the prices that you need to remember is face value, the price at which each share is quoted in the balance sheet; issue price, the price at which the company issued the shares; opening price, the price at which the shares opened in the market; and market value, what is the price of the shares today. So today the price of the shares is 1425, a face value of 5 rupee. Company demanded 95 and it opened at 145. So the securities premium is the difference between the issue price and the face value. So based on this, when the company raises money for the very first time, such an issue is called as a IPO, and Infosys has raised money multiple times. They didn't just issue a few crore shares in 1998. They kept issuing shares over and over again. So if the company again issued shares to the public, then it will be after the IPO. So such issues are called FPO. But if the company decided to issue shares only to those people who invested in the IPO, so if the company issues the shares only to its existing shareholders who have already invested in their IPO, and I only want to receive money from them, I don't want money from public, I don't want to give anybody else the chance to invest in my company, such an issue is called as the rights issue. And in rights issue, you will receive consideration and money from your shareholders. But if you don't take any money at all and you end up giving them free shares, such an issue is called as a bonus issue. Are we clear? So rights issue and bonus issue, both are securities issued only to existing shareholders. But for rights issue, you take money from the existing shareholders. For bonus issue, there is no consideration. Why would a company give a bonus issue or issue shares for free? Because the company is performing well financially. It has a lot of cash surplus. So it wants to amortize and use that and issue securities and keep the shareholders happy. So Infosys has done bonus issues multiple times in its history. So anybody who had one share, suppose a company does a 1:1 bonus issue, any person who has one share will get one bonus share for free. If they do a 2:1 bonus issue, anybody who has two shares will receive one extra bonus share for free. And if the same thing they do for rights issue, if they say 3:1, anybody who already owns 3 shares has the ability and eligibility to buy one more share in Infosys, but you have to pay for it. That is what is called as a rights issue. But if you don't do public issue and neither do you do rights issue, if you don't do either of these and neither are you issuing shares for free, then obviously you would be doing private placement, which is also called as preferential issue. Preferential issue is an issue which is done only to meet the requirements of the company in scenarios where it needs money urgently. So rather than going to your existing shareholders, what if you approach only some of the existing shareholders, not all of them, or you approach completely new people? So let's say Infosys goes to State Bank of India and says, you know what, I need 10,000 crores urgently and I don't think my existing shareholders are in a position to give me 10,000 crores. Do you want some of my equity shares? If it goes to SBI, Infosys is said to be giving preferential treatment to SBI and not giving that treatment to its existing shareholder. That is why we call it as a preferential issue. So when the company does not issue the securities to all of its existing shareholders, it only selects a few. So for example, in this class, if I am Infosys, I only issue shares, I only call Kusuma, Gagana and Manoj to invest in my company. I am obviously giving preference to them. All of you are my existing students, assuming you are also my existing shareholders. If I give all of you the option to invest in my company, then it's a rights issue. If I give all of you free shares, then it's bonus issue. If I allow you as well as all my students and the entire country to invest in my company, then it's a public issue. But if I only give these shares to selected people, then such an issue is called as a preferential issue. Therefore, what are the four types of issue of securities? First is
Public issue.
public issue can be divided into two types. What are they?
IPO and FPO. IPO and FPO.
IPO and FPO. What is the full form?
Initial public offer or further.
Initial and follow-on or further public offer. Public issue is accessible to whom?
To the public. To the public, actually, for the first time.
Not say general public, just say everyone. Everybody can access a public issue. General public also has a definition under our subject, which we'll learn later on. General public only means investors like you and me. But banks can also access a public issue. Mutual funds can also invest in a public issue. Any debenture holder, if he wants, he can also invest in a public issue. So everybody can access this public issue. It's free for all. That's what a public issue is. If you give your securities to existing shareholders for money, what type of issue is that called as?
Rights issue.
That is called rights issue. If you issue your securities for free to your existing shareholders, then it is called as
Bonus issue.
bonus issue. And if you don't want to give your shares to existing shareholders and you also don't want to give your shares to everybody, but you only want to give your shares to selected individuals, then what type of issue is that? Preferential issue is the term we will use in this subject. The same term will be used in Companies Act and SBEC as private placement. So these are the four types of issue. In which market does this issue occur? Don't tell me stock market. There is a specific name that I mentioned. Primary market. The market in which this security is issued. Any security, when it is created for the very first time, it will be created by the company. And they have to approach the primary market of the stock exchange, and which intermediary is going to help them in issuing all of these securities? Who are they called as?
Primary market intermediaries.
And if I want to buy this share at 1425 today, is this primary market? No. This market is called secondary market, what you're seeing on your screen right now. Infosys has not issued any shares for a very long time. It has got sufficient amount of money raised from India and abroad. So only the existing shares are being traded, bought and sold. So is the share capital and balance sheet of Infosys going to change because of this? The answer is no. Infosys is not affected by what happens in the stock market in terms of its balance sheet and its share price. Yes, public sentiment is important, goodwill is important, etc., etc. But at the same time, Infosys is not as affected by the secondary market as it is by the primary market. So the secondary market is what you see on screen right now. If me and you have to buy a share of Infosys today, Infosys is not going to give us these shares. So we have to go to stock exchange. And which stock exchange? Recognized stock exchange. And the people who help us in buying and selling shares, in opening demat account, in placing orders, in transferring money from our bank account, etc. They are called as secondary market intermediaries. So you have two types of intermediaries and two types of market. What are the two types of market?
Primary.
Primary and secondary. And what are the two types of intermediaries? Also primary and
secondary market.
Primary market is the market in which a security is created. So it deals with security creation. Secondary market deals with security trading. Trading means both purchase and sale. Any other doubts in all the topics that we have discussed today? Any queries till now? Let's now go back to that initial. Yes, somebody had a question, Manjunath?
Yes, so the part where you said we're dealing with listed companies and we have nothing to do with what type of company it is. Does that mean that a private company also can be listed?
Very good question. What do you think? Can a private company be listed?
I think not.
Private company usually has three restrictions. You would have studied this either in module 2 or you will be studying this in module 2. I don't want to go all hardcore on you guys in the very first few classes, but yeah. Section 2, subsection 68 gives us three restrictions that a private company has to abide by. It restricts the transferability of shares. So if a private company issues shares or debentures or any securities, the transferability is limited. It also restricts the number of members to 200 or 1 in case of one-person company. And it prohibits issue of securities to public. Meaning a private company cannot issue securities to public. What did we just see? We just saw the process of issuing securities to the public, which is called as IPO and FPO, which are both your public issues. So if a private company cannot do public issue, it means private company cannot do IPO. So if a private company wants to get listed, first it should get converted into a public company. Once you get converted into a public company, these three restrictions will go away. Then after becoming a public company, then you can become a listed company by issuing your securities and signing the listing agreement. So that is the process of a private company becoming a listed company. Are we clear?
Yes, sir. But what about private placements? That's also ruled out. Because
private placement, a private company can still do.
Okay.
As long as it is to those 200 people only. That is the whole point of private placement, right? Private placement can only be done by a private company. Public company can do it with anybody, but private company can only do private placement to those 200 people who are already its members. So let's say a private company has 73 members. It cannot do private placement to 200 people. It has to do it only to those 73. And if it wants to increase its shareholders, yes, it can, but it cannot do public issue. So it has to invite another 127 people to invest in its company privately. That's why they do one-on-one meetings. Some people go to Shark Tank, some people approach mutual funds, some people go to venture capitalists. There are many ways in which a private company can get funding. All of that obviously is part of the syllabus in the future. But yes, private company can still do private placement, but it cannot do public issue.
Okay, sir. Thank you.
Other doubts?
Yes, so just to confirm, like even private companies do rights issue and bonus issue, right?
Private companies, again, subject to the same limitation. Private company can do issue of securities only to those 200 people. However you do it, whether you do it by private placement or preferential issue, whether you do it by rights issue or whether you do it by bonus issue, you have to only do it to those 200. The only prohibition is doing public issue. Public issue we just saw is of two types, IPO and FPO. This private company cannot do. The other three, they are still available to a private company and they can still go ahead and issue the shares to their existing 200 members of the company. There is no restrictions there.
So with regards to private placement, right? You say a private placement is done when a company requires or when a company is in need of money. So you said it can go to new members.
It can go to new members subject to that number not exceeding 200. So if I've already taken money from 200 people, then private placement is ruled out. Pretty much. Because your existing investors will be like, "Arey, aur kitna paisa lega main?" De diya na. So either you have to do rights issue to all the 200 people, or you have to give them free shares, which is not going to fetch you any money at all. So bonus issue is also ruled out technically. You are left with pretty much rights issue as the only option. And suppose, let's say for some reason, out of the 200, you only want to give shares to 20 people who are your closest friends. Won't the remaining 180 people ask you questions? They will ask you like, why the hell am I not allowed to invest in this company? Why only these 220 people, right? So if you do private placement only to 20 people, you have to do it to only those 20 people out of the 200 that are existing. And the rest 180 will start protesting, which is not good for your company practically. So that is the only realistic option left, is to do a rights. And that is what most private companies end up doing anyways. Are we clear?
So I have a very silly question. We've discussed issues, but there is no prohibition of listing those shares of a private company in that case. Once it's been issued.
No, listing is only possible if you sign listing agreement. Who can sign listing agreement? Only a public company. So automatically private companies are ruled out.
Okay, thank you.
Okay, and remember, no question is silly. You ask me the dumbest stuff, I would be more than glad to clear your doubts. The subject is as such, I understand, and the more questions we have, the better the class also is, right? So I'm all for it.
Thank you, sir.
Anything else?
Earlier you said Sensex is the index of BSE. What is the meaning of index?
Good question. Let's go to the website itself and clarify. So you see S&P, BSE, Sensex, you see this? So you click here. Market is closed, otherwise I would have shown this to you live. Maybe someday, okay, all of you guys are busy, so maybe we won't be able to do any class when the market is live, probably. But fine, we'll give it our shot. This is what your Sensex usually looks like. If you count how many companies are there on your screen?
30.
Right, 6 into 5, there are 30. So this Sensex is an index of the top 30 companies that BSE has decided with its own algorithms in place, which impact our economy the most and which are the most highest contributing companies to not only our economy but also very high on market capitalization. So you would notice companies like TCS, Tata Consultancy Services, Tech Mahindra, Infosys, HCL Technologies, Wipro, Tata Steel, Nestle India, Asian Paints, Larsen & Toubro, Hindustan Unilever, Tata Motors, ICICI Bank, JSW Steel Limited, HDFC Bank, Bharti Airtel, ITC, Indian Tobacco Corporation, IndusInd Bank, Bajaj Finance, Kotak Bank, Bajaj Financial Services, Reliance, State Bank of India Limited, Axis Bank, NTPC, National Thermal Power Corporation, Sun Pharmaceuticals, Ultratech Cement Company, Maruti, Titan, Powergrid, and Mahindra. This, according to BSE, are those 30 companies that, through their ability to both generate revenue and be profitable and also having high market values. You notice all of these shares are reasonably highly priced. You see Reliance is at 2,738, TCS is 3,510, Nestle is 23,000 rupees for one share. Asian Paints is 3,400. So a combination of these securities, if you add all of these individual values, all of them will be given a weight based on their contribution to the index. Everybody is not getting equal weight. For example, Wipro, which is at 404 rupees, is not as valuable as maybe a TCS. So TCS may be given 3 weights and Wipro might be given 1 weight based on how BSE designed this combination of 30 securities. And BSE at any point of time can also remove one of these companies and put something else. For example, Powergrid is struggling a lot at 240 rupees. Also not performing very well profitability-wise. So they will then add some other company apart from Powergrid to this index, and the collective weighted average price of all of these 30 companies put together is what is called as the Sensex. And the same thing for Nifty. Instead of these 30, you will get another 20 companies added to this list. There you will have 50 companies. So Nifty rhymes with 50 and 30 for your Sensex. The collective weighted average price of these 30 companies represented together is 66,060 today. So if you want to buy this collective basket of securities together, you can do that by paying 66,000 rupees. So that is how the market usually works.
Okay, sir. Thank you.
Okay.
So, sir, the Sensex 30 companies, is it?
Yeah. Sensex is a combination of 30 company securities. So it's like a basket. Imagine you go to KR Market and you buy a fruit bowl. You get some apple, you get some mangoes, you get some bananas. So imagine these as the fruit bowl of India, but with respect to companies. 1 second, guys. Yes, any other doubts before we close for today?
Sir, I heard about price share value and BSE and NSE are different prices.
Correct, because their pricing mechanisms are decided by different sets of people. Usually the price will be very similar. It won't have much of a difference, but there is a chance that you might have like a few paisa difference here. So let's take an example. TCS is how much? 3512 here, right? So let's put NSE and check how much is TCS. We'll get an idea there. There's usually not a lot of difference at all. Even if it is, it will be a few paisa based on when the stock is opening and closing. So if I'm going to search for TCS here, let's search for TCS and we will find out that see 3509, very, very close. And this change also only occurs because very slight differences in quantity purchased in both the stock exchanges also. BSE usually has a higher quantity purchase usually. And most companies are listed on both stock exchanges, but you would find that there are some companies in India that are only listed on BSE or only listed on NSE. This is done because you have to pay listing fees to both the stock exchanges. So that's not very cheap. So rather than paying for two stock exchanges, if you allow your securities to be listed only in one, then that saves you a lot of money but gives you the same visibility. Let me check whether any such company is there. Mindtech. I believe this company is only in one of the stock exchanges. So you see the price 134, right? Mindtech India Limited. If I go to BSE and check the price of the same company, okay, it is there. They were not there before though. Mindtech was only there on NSE before, but you will find companies like these which only are listed on one stock exchange, and whatever price variation you see will be lesser than 1% usually of their actual market price, mainly due to the quantity that is being traded in both the stock exchanges. Let's now come to derivatives and end today's session. So you have futures and options, both are derivatives. One of the options that you saw is employee stock option, ESOP. Then you have DSOP, which is director stock options. Both of these come under the category of call options. Both of them give you the right to buy the share. But if an option gives you the right to sell the share, then it is called as a put option. So rather than having the right to buy, if you get the right to sell and you pay a premium to acquire such an option will be called as a put option. In both call and put option, you have the opportunity to back out of the contract if you don't achieve your price. But you cannot do that in futures. Forwards and swaps are not traded on stock exchanges, and they are also not traded on both BSE and NSE in India. So I will explain what they usually are probably in the next class. So India only deals with futures and options usually. Futures and options are very similar in nature. Let me explain both with the help of an example by taking Infosys itself. Infosys is 1425 today. You are neither an employee, you are neither a director. You are just like me. You are just a third party who wants to buy Infosys shares. Let me ask Manoj. Manoj, what do you think is going to happen to Infosys 3 months from now? You think the price is going to go up or come down?
Sir, go up, sir. Might be go up.
How much do you guess? Okay, what do you feel personally?
Sir, it will go up, no, sir.
And up to what price are you expecting it to go up?
Sir, maybe 1600.
1.5 or 1.6?
1.6, sir.
1.6 in 3 months? Okay. So Manoj enters into this contract with me because I believe Infosys is never going to touch this price. But I have found a buyer. So for Manoj, he has a call option. He wants to buy Infosys, but not at 1600. Obviously, Manoj is going to negotiate now. He expects the price to be at 1600 after 3 months. How much do you want to buy Infosys at, Manoj? You also want to make a profit, right? So how much are you ready to pay for this? Today it's already 1425. I want 1500. Are you okay with
Yes,
it?
sir. Yes, sir.
So we are going to enter into a contract at 1500. After 3 months, Manoj expects this to be at 1600. It could reach 1600 or it could fall down to 1300 also. In a futures contract, irrespective of whether it is 1600 or 1300, you have to pay 1500 to me after 3 months. You cannot back out of this contract at all, Manoj. Such a contract where you pre-decide the price, pre-decide the date, pre-decide the quantity. Let's say we're going to buy 1000 Infosys shares. So you have to pay me 15 lakh rupees after 3 months. And if it goes up to 1600, fine, you made a profit of $100. But if it goes down to 1300, which I am expecting it to, I will make a profit of 200 bucks. We both don't know what's going to happen. This is what is a futures contract. But in an options contract, Manoj is going to pay a premium of 15 rupees to buy a call option. So what Manoj is going to do is, he's not 100% sure that it's going to go up to 1600, right? So what Manoj is going to do, Manoj is going to say, you know what, I'm going to give you 15 rupees in advance, but I want the option to back out of this contract if it falls below 1500. So for me, the seller, 15 rupees is a profit. Manoj is paying 15 rupees extra. Today itself, Manoj is ready to pay. So what Manoj is saying is, I will still buy the Infosys shares at 1500 after 3 months.
Sir?
No.
So as I was saying, when will Manoj be able to continue with this contract? In which scenario would he prefer to continue? When the price is 1600 or when the price is 1300? What do you guys think?
So could you please pardon?
The contract was entered at 1500. After 3 months, the price is at 1600 in scenario 1. Will Manoj end up buying these shares at 1500 or will he back out of this contract?
He'll buy it.
So he'll buy by paying me 1500 rupees, but he's already paid me 15 rupees per share. So his net profit is only going to be 85 rupees. The second scenario, he's not going to pay me 1500 at all because the price is already at 1300. So he's going to back out of the contract. But he has already paid 15 rupees, so his net loss is 15 rupees. This is a typical call option. Now let's look at a put option. Again, Manoj prefers to this time not buy the shares, he wants to sell the shares in the future. Infosys is 1425. He wants to sell it at 1500 again. After 3 months, the price will be 1600 or 1300. When will Manoj continue with the contract and when will he back out of the contract? This time. This time, he's not gonna continue the contract if the price reaches 1600. You know why? Because he wants to sell the shares. If the market price is 1600 and the contract price is 1500, as a seller, it is more profitable for Manoj to sell this in the market. So he will back out of the contract. His loss will only be 15 rupees. But if the market price is 1300, he will continue with the contract and he will sell the shares to whoever that is at 1500. But this time he's going to make a profit of 200 rupees, but he has already paid 15 rupees in advance, so his net profit is 185. Did you understand what just happened here?
No, sir.
Once again from the beginning. This is a put option. Put option does not give you the right to buy. Put option gives you the right to sell. So you are the seller. The contract was entered at 1500. After 3 months, the price can reach either 1600 or 1300. You have agreed to sell the shares at 1500 to me. Before you had agreed to buy the shares from me. Now you have agreed to sell the shares to me at 1500. You have agreed to sell it at 1500, but the market is already at 1600. Would you want to sell it at a lesser price to me, or would you go and sell it in the market at 1600? What would you do if you were Manoj?
We'll sell it at a higher price.
You want to sell it at 1600, so you want to cancel the contract?
1300.
So if you want to cancel the contract, you have already paid 15 rupees to me, so your net loss is 15 bucks. But if the price goes to 1300, As the seller, will you sell it at 13 or will you sell it at 15? As a seller, 1500 makes more sense, right? So you will continue with the contract and you will sell it to me at 1500. But you have already paid 15 rupees as premium. So your net profit is going to be 100. So from a seller's perspective, price fall is good. From a buyer's perspective, price rise is good. So if you're a buyer, you're expecting the price to rise. So you are called as the bull. As a seller, you're expecting in this contract for the price to fall. You are called as a bear. This is where the terminology, the big bull, came into the picture. You're expecting prices to rise all the time. Then you are considered to be a bull. Are we clear with these terminology?
Who is the intermediary?
Sorry?
Here, who is the middleman?
Middleman will be the intermediary who places the order here, so it will be the brokers. And which intermediaries are going to perform this contract, primary or secondary? Am I buying the shares from company
Secondary.
or am I buying the shares from investors directly? So here we are going to do secondary market intermediaries. Right? So yeah, that's pretty much all the terms and terminologies for today.
This put option and sell option, which is the rights of the buyer or the seller, is it usually in ESOPs and DSOPs?
No, these are separate from ESOPs and DSOPs. These are the other two options that are there. ESOPs and DSOPs are traditionally only given to employees and directors. Manoj and me are not employees and directors of Infosys, right? So we have to go for call options and put options. Both ESOP and DSOP are actually a type of call option which gives you the right to only buy. You can't sell your own company shares. As an employee or director, you have not even got it yet. So you can only sell it once you have got it or received it. So you have to buy it first through ESOP and DSOP. So you can say ESOP and DSOP is a type of call option which is exclusively reserved for employees and directors. But for people like you and me, we have to go to the futures and options segment of the stock exchange and we have to enter into call and put options. Okay?
So call options and put options are available in other kinds of issue of securities. Like
we are not issuing securities at all. We are only trading in securities. Securities are already issued. We are only buying and selling them.
Yes. Okay.
All right. Any other doubts?
So ESOPs and DSOPs, when they are issued, does the company usually allot them or buys it on behalf of the employee director?
Usually companies allot them. They will create a new batch of securities exclusively for ESOPs and DSOPs. That's what usually happens.
So how does the consideration work? Like there's nothing at the moment, it's just allotment?
No, currently the market price is 1425, right? So if you join the company today, you join the company when the company is already at 1425. So you will be given the shares at 1425, but after 3 years. So you might be wondering, what is the use of even buying ESOPs when I can go and buy it in the market, right?
Yeah.
The only advantage is you're going to get a lock-in. You don't have to pay 1425 today. You are locking the price today, that's all. There is no exchange of money at all. That's the biggest advantage of ESOPs. If you want to buy Infosys shares, today you have to pay 1425 into 1000. So today you need 14,25,000 rupees. But you don't have 14,25,000 rupees. You just joined the company, right? So you just lock the price. You work hard for 3 years. Hopefully everybody else also works hard and the company performs well. And if it goes to 1,700 after 3 years, you still end up paying only 1425 and you end up getting a share which is worth 1700. That's the whole point of doing ESOPs in the first place, to make sure employees continue to work in the same company.
So is that the discount that you're talking about? Share at
There is no discount here. Where is the discount? You just made a profit. Company didn't give you 1 rupee discount. Company only locked the price at 14.25. Did they give you any discount? No. Discounts therefore can only be given to sweat equity shares. ESOPs are not even shares, they are derivatives. ESOP derives value from the fact that Infosys should do well. Only then ESOPs will make sense. A derivative doesn't have a value of its own. It derives its value from something else. That is why futures and options are called as derivatives. If Infosys does well, we can make profit and loss. We directly are not buying Infosys. We are betting on the fact that Infosys may do well in the future. So in simple words, all of this is gambling. In reality, that is what it is. You don't know. Might as well go to a casino and roll a ball in a roulette table. You might end up getting a number. That is pretty much it. But here there is a higher probability of you making more money because you're working for the same company. So if you work hard enough, this 1425 will become 1700. It will fetch you profits. Infosys did not give you any discounts. They just froze the price. That's all they did.
So what if the employee agreed for 1425, then after 3 years it fell down to 1400? Is
Or
the
let's say even $1,000.
Yeah.
So if it falls to $1,000, what is the basic nature of an option?
If the employee can, then you need to pay the balance amount.
No. Can you back
You
out?
can back out of
Can drop
the.
Yeah, you will back out. Why will you pay 1425 for something which is available in the market for 1,000? It's like buying tomatoes and mangoes and cucumber, guys. Don't complicate it too much. If a vegetable vendor comes to your house and gives you tomato at 20 rupees, why will you go to KR market and pay 150? Same thing. So you always have the option to back out. This is not compulsory. None of this is compulsory. If you want, you buy. Otherwise, you back out. That is an option. But in future, that option is not there. If you freeze 1425, you have to pay 1425. That is why this is not called as employee stock future. This is why it is called employee stock option. You have the option to back out.
Sir, so you said when ESOP is issued or allotted, for example, you said the company will separately allot shares aside for ESOP, right? So they will freeze those shares at 1425 and then keep them aside.
No, that's not how the process works. Process is far more complex than that. If that was the case, every other company will be issuing ESOP. So what the company will do is, depending on, this is quite a multi-departmental issue that we are talking at. We cannot just look at it from SLCM perspective itself. You have to look at, there is company law implication here, there is SPC implication here, there is SLCM implication here, there is tax implication here, there is a
Contract law.
There is contract law implication here. You cannot just say company is going to allot these shares. No. Company is going to think, okay, I'm going to hire 100 employees today. Every day company will hire somebody or the other, right? And people will leave the company also. So let's say today 100 people are joining. Out of them, 10 senior people are at a place or at a designation where they're eligible to receive ESOP. Who's going to decide this? HR department. HR department will have their own HR policy by which they will say employees of a certain pay grade and above are eligible to receive ESOPs. So out of those 10 employees, company would say, you know what, from our experience, every 7 out of 10 employees usually takes up our ESOPs. But I cannot be 100% sure, so what would I do? I'm going to offer 1,000 ESOPs to all 10 of them. So I will make a provision and I will create a reserve. There are so many implications. We cannot just state, SLCM wise what's going to happen. So for 10,000 equity shares, I'm already going to create a reserve and keep it aside, saying maybe in the future, if all these 10 people take up these shares, I need to create 10,000. I need to allot 10,000 more equity shares. So I need to create a provision for this accounting wise. This 10,000 shares may be taken up after 1 year. 30% you're eligible to take up after 2 years, another 30% you're eligible to take up after 3 years, 40% you're eligible to take up. Do you think all employees will take up 30% after 1 year? Not necessary. Let's say 3 of them took that, 7 of them said no, I want to wait. Second year, 4 of them took 30%, 3 of them took 60%, and 3 of them said, I will wait. Are you following what's happening here?
Yes, sir.
First year, 3 people said, I will take the 30% as soon as they are made available to me. So 30% of 1,000 is 300 shares. 3 people took 300 shares. 3 into 300 means 900 shares should be allotted after 1 year. In the second year, 4 people said I will take 30% shares. 3 people said I will take the entire 60 because I didn't take it for the first time. And 3 people are still remaining silent. So company is going to issue 60, that is 600 shares into 3. So that's 1,800. And another 300 shares into 4. So that's 1,200. So 3,000 shares will have to be allotted after the second year. The remaining number of employees, 3 of them are there. All 10 can take the 40%. So let's say all 10 take the 40%. These 3 take the balance also. Let's say all of them take up. Now this is just one combination. What if one person dies in the middle of this? What if one person quits the company in the middle of this? What if one person becomes disabled in the middle of this? There are so many possibilities that can happen in the middle of these 3 years, right? So you cannot just say that this is exactly what's going to happen. It totally depends, but companies should be prepared. That's the whole point. So companies already allocated money for creating these 10,000 securities, irrespective of whether these people take it or not. As and when these people decide to take it, they will take this securities from this reserve and they will start allotting these securities to those shareholders. And at the end, if some securities are left over, they will add it back to the pool, and maybe in the next lot, when I hire another 100 people next year, maybe some of those people will buy my shares. This is quite a trivial affair if you look at the bigger picture of how a company is run. This is quite a trivial thing. Company law-wise, you will have to file PS3, you have to convene a board meeting, get board resolutions passed, you have to get compensation committee meeting. On the background, HRs have to conduct meetings on the background. You have to allot 100 of these people their employment letters. 10 of these people will get ESOP allotment letters. After 1 year, they will get vesting letters. So procedurally, it is never ending. Unless you work for a company, practically only then you will be able to figure out what exactly happened. But this is pretty much what happens in a nutshell. So it's mainly a HR call. It's not even a legal call at all. Mostly the HR people will decide whether an employee is going to be eligible or not eligible.
Are they shares?
Yes, one by one. Yes.
So when you said allocating money, what exactly did you mean? Like the company buys them for you at the moment?
No. They not buy. Company only does allotment, right?
Allotment.
So company just has to create a security, which is very easy for the company. There's no, they just create an accounting entry and they create the securities in the back. So the security certificates will be printed and kept. Only name column will be kept empty. That's all. If you're looking at practically how it works. And today, though, that also is not required because it's only in DMAT. So you can directly allot the securities online.
Okay, all right. But this happens even in private companies as well. So
yes, it does.
Does this happen only when they go into IPO, or what if they don't go into IPO? That doesn't matter, is it?
It doesn't matter. ESOP has got nothing to do with IPOs at all. We are talking about secondary market. IPO, FPO, public issue, rights issues, primary market.
Okay.
This is completely different. So your subject is designed in such a way that one part you study about primary market, the other part you study about secondary market.
So even if they go into IPO, that doesn't affect the ESOPs that the employees or directors hold?
Employees have their own personal contracts with the company, so that's not really going to affect what the IPOs will do.
Okay.
I would say much, but if the company goes for an IPO in the middle of these 3 years, some employees might want to take up the share early. Some of the employees might want to wait after the IPO. So there could be pricing implications. But as such, there need not be any decision-making problem for the company because these are pre-existing contracts with the employee.
Okay. But if they do well in the market, then it's sort of beneficial for them.
A company goes to an IPO only because it has done very well. So IPOs will only occur if you are a great company. So automatically everybody will want to exercise their options and get these shares at those prices. So employees will be extra excited if you are having an IPO. So that's actually good for the employee.
Okay.
Sir, is there a limitation on maximum number of shares to be issued by a company?
The total number of ESOPs can never exceed, depending on the company, overall you can keep a number of 25%. So basically
not only limited to ESOPs, if any company, for an instance Infosys, if do they have limit on this is the maximum number of shares that can be issued?
Their compensation committee can decide that accordingly.
Okay, but from SEBI rules
legal perspective, usually 1 out of every 4 share maximum can be given to employees. You cannot raise all your money from your employees themselves.
So not regarding ESOP, sir. Like generally, how many? Like, is there a limit on the maximum number of shares that
Capital?
can be?
No. Not at all. You can raise crores and crores and crores worth of money, and that's
As
what
long as there are regulations.
Yeah. As long as SEBI is okay with it, no problem.
But theoretically, it's the capital that authorized capital that's mentioned in the memo.
Exactly. So as long as it's within your limits prescribed in the MOA, you are okay to raise. But even that limit can be tweaked. You can alter your capital clause in the MOA. You can raise that limit, and pretty much, as I said, sky's the limit. Raise as much money as you want as long as there is demand for the shares of your company. No problem at all. All you need to do is tweak your MOA capital clause by passing a special resolution, increase your authorized capital to, let's say, 20,000 lakh crore. Make some ridiculous number that nobody even wants. So keep it at that limit, and you don't even have to alter it. If you really look at it, if you draft it right away when you're incorporating the company itself, if you get a good drafter, they would put in the right kind of capital clause inside your MOA and your problems are solved. You never have to tweak your authorized share capital at all.
Sir, in case of going back to ESOPs, so are they issuing fresh shares or are they giving away the part of
they are issuing fresh shares subject to the condition that employees take them.
So in case if the employee doesn't exercise the option of ESOP at all, so the share remains unissued at it.
So they will only create it when they exercise. So there are 3 stages. The initial ESOP letter that they will send you, then the vesting period of 1, 2, or 3 years, and then the exercise. In the allotment letter, they would mention everybody is eligible to get 1,000 shares after a period of 3 years. But exercise, let's say only 500 happens, they will only allot it once the exercise happens. So I'm not creating any shares and keeping them idle for 3 years. I'm only creating the shares after they are exercising their rights. So I'm not wasting any unnecessary resources here.
So in that case, taking Infosys as an example, the face value will remain ₹5, and then you'll be...
The issue price will remain 1425.
So they're making a huge securities premium in that case, when you exercise the 500.
Not really, because if you had done an IPO, you would have only got 95 rupees. So you're taking money from your own employees for staying loyal to you. That's pretty much what this is. There is no exceeding complications are not there in ESOP as such. You're just giving an opportunity to your employees to become owners of your company. That's all we are doing. 1425 was the market price today. Today is when you joined, so you're supposed to pay this money. I'm not taking anything extra, I'm not taking anything less, I'm taking what is fair. So you may call this as securities premium. Yes, technically 1420 is securities premium. But yeah, you're just taking the market price for the shares of your own company. So that's also there.
So this is a secondary market. Sorry. This is a secondary market transaction. It happens in secondary market.
It is a overall market transaction. It is not just primary, it has secondary nature also. Because of vesting, it has tradability aspects also. So you cannot just put this under primary or secondary. ESOP is a little special in that regard. ESOPs and ESOPs are, because there is allotment, there is creation of a new security, but you're also taking money. So technically your employees are buying the shares from you. So this is not really a primary or secondary market. This is a unique transaction of its own.
Okay.
So for Infosys, we know it's 1425, but for a private limited company, how would you determine the market?
You would have to appoint a registered valuer who is a practicing chartered accountant who will value the shares of your company, and he will give you a certificate. Based on that valuation, you can receive the money. And that is where we open up the whole possibility of bribery and corruption. Because the CA says it's 5,000 rupees, it's 5,000 rupees. I can pay the CA some money and ask the value to be quoted high. Why do you think these scams happen? This is why. This is one of the reasons, not the main, one of them.
So in case of a private company, you do exercise your ESOP. What do you do with the ESOP that you've gotten, right? You don't have a market to sell it.
Why not? Why don't I have the market? After I exercise the shares, I will get the shares in probably 2 days' time from the company. My Demat account will be already saved with the company that I joined 3 years ago, right? So they'll directly credit my Demat account. There will be a lock-in period for 1 month or 1 week, or sometimes no lock-in period also some companies have. And as soon as you get the shares credited in your Demat account, go ahead and sell it in the market for that 1,700.
No, in case of a private company, you do not have that market, essentially.
So you have to find an investor to sell it then.
So it has to be one among the 200 people that you sell the...
Employees are not counted amongst 200. That is why. Past and present employees, if you read section 2, subsection 68, in that 200 past and present employees, for this particular reason only, they are not in. So employees, even if they own shares, will not be considered as part of that 200. So you sell it to whoever you want. You convince one of those 200 people to buy your shares and it's over. You made the money. But in reality, now let's talk reality. Private companies won't give you ESOPs. Let's talk about that also. Private companies will 99% of the times not give you ESOP. उनके पास ही पैसा नहीं है. They only don't have money. They're looking for investors to expand. Why will they give you an opportunity to make even more money than your salary? These are all perquisites, right? So, yeah, most private companies don't. Listed companies will. Anything else?
So when we buy or sell a share through the secondary market, then whom are we buying the shares from and whom are we selling the shares?
So let's say you're the employee who got these shares, right? So you go to the market, you place an order, let's say 1,700. You see this place, market depth. Currently market depth is 0. Here your order will pop up as a seller. So 1,000 shares will be the quantity and 1,700 will be the price. Accordingly, based on the market depth, if you find a buyer at the same price, your transaction will automatically go through. Who will that buyer be? Nobody will know. Only the buyer will know he is the buyer, and only the seller will know he is the seller. The intermediary will know who's the buyer and who's the seller. You have to generate a report for that and find out who actually bought your shares, because there are literally millions of people waiting to buy and sell these shares all the time.
Okay, sir. Thank you.
Anything else? Tomorrow Rahu Kala Yavaga. That also we need to discuss, or that's it? Okay, thank you for all the questions. Hopefully, we have reached some sort of clarity regarding what the subject is going to be. So, going forward, if you have any doubts, ask